Hey, what's up, guys? How's everybody doing? Wanted to talk to you guys about something I thought was pretty important. Somebody had asked me in our chat room yesterday about the proper way to scale out and really capture like a big part of a move. And so, when you're in trading, there is different aspects of a setup and a trade, and they all have equal importance, I think. And so obviously, the first thing that, we're always looking for is, of course, price pattern. And then, of course, your entry is really probably the biggest and most important part of the trade, because that kind of governs your risk management and everything like that. But a lot of people, myself included, are very good at getting great entries. But just because you get great entries doesn't mean you actually have like big winners. And I think that in trading, unless you can have 3 or 4 chunk plays every week, it's really hard to sustain profitability when you're counting for taxes, commissions, market choppiness, so on and so forth. What you need is a few plays every week that kind of give you those chunks. And so a lot of times when you're day trading throughout the week, you may be taking 50 cents or like a buck or, right, like smaller gains as you're kind of weaving your way around taking shots. But what's going to happen is a few times a week, you're going to be faced with an opportunity to get in a stock that trends, that actually has the ability to go up most of the day. And I had an awesome entry on this trade in crowd yesterday that, I had been stalking all day, but I kind of goofed up, the sales. And so one of my students in the chat room was asking me, how come you sold this thing so early? We had a big winner. And so, I ended up, adding this thing at like 71, and I sold out of some of it so quick, and then the rest of it really, really quick. If you see here, my scale outs on this thing was like really like within 40 cents of each other. And that's a huge mistake when you get a stock that actually has the ability to run. And so let's first talk a little bit about the setup and why I liked it. And then I'll kind of walk you through what I did and how I could have done it better. So I had crowd on this list as a rounding bottom IPO play. So IPOs were hot like a month ago, and then they were not. And that's the nature of themes in the market. So in June, Fiverr, RVLV, crowd, there was a lot of them that were exhibiting a huge amount of momentum. And then they tanked or retraced, but pretty aggressively. Now with any stock, at some point you'll start to round about and start to heal, right? Time will allow buyers and sellers to reach equilibrium. And as you start to round, we'll watch that 9 EMA. As soon as it starts to curl up, that'll tell us that, okay, we have a rounding bottom pattern, but also that the short-term moving average is starting to point up, and we might start getting at least a short-term trend. So I had this on my list. And yesterday I had a gap, which is, gap to me is on a stock like this, especially when it's coming out of, its rounding bottom. To me, that's a strong sign that, there may be some momentum throughout the day. So, as this thing popped up, I just pretty much ignored it all morning, because this type of pattern, like here, this is an ORV pattern, but it doesn't really work well in this type of stock because at the open on this stock, there's really a lack of liquidity. Even though it's a $13 billion company, there's a lack of liquidity usually in that first hour. And so I don't like OR being that kind of stock. I find that the failure rate is much higher due to the lack of liquidity. So I want to get it as it tightens up. So, later on, it kind of pulls back to the 20 SMA and pops back into 71. Now, when it pops back into 71, I'm interested in it. But if it broke out here, like, I wouldn't actually add it. The reason I wouldn't add it is that it's really just the second test of the 71, and then it's also really loose. So when you have a trading pattern, if it's loose, meaning the difference between the breakout and where your 9 EMA and VWAP is, if there's a lot of space there, then you're going to have a choppiness, and the breakout actually has a much higher probability of failure. So what I need is that level to really tighten up. And so I'm watching this 71, but I need it to tighten up. So as it starts to really tighten up here and you're kind of testing, I add in this area over here, and I just put a stop under my 20 EMA. So I added near 71. I got like a 70, 75 stop loss on it. So, and then I want to add another like 20 cents on the stop loss because the stock has a spread on it. So like if I'm thinking that I need a 25-cent stop loss and the spread is also give or take that many cents, I want to essentially use like a 50-cent stop loss. And so, I'm thinking, okay, I'm going to have a max risk between 40 and 50 cents, depending on how it moves. And then, I'll be able to manage this trade. And so I really like the entry. I like the setup on the daily. So when we think about trading, right, we want to build a case for why a trade is worth our time and our energy. So first thing we look for is price pattern on the daily, right? Then we look at the volume. Then we want to look at our intraday setup. And so I have an intraday setup here for a flat top breakout. And I've got my EMAs really curling up. So I get this thing perfectly at 71. And then like in this first candle, I scaled out half my shares, which is, probably a mistake, and I think in hindsight, it's a mistake. And the reason it's a mistake is that, what a student was asking me is, how come you sold the thing so early? It went up all day. And, as I'm reviewing my trades, it's like, you're right. Like, why would I do that? So what we need to do when we think of targets is think about like when a stock really moves, how much does the actual range on these candles go, right? So like you can see like this stock has just in some candles, it moves $1. The other thing is like it moved from here from 69 to, 71, 69.50 to 71. So we can see like in just even in today, it has the ability to move at least $1, $1.50 very, very quickly. So my first scale out at like 71.64 was definitely early, right? One of the things that I have to be mindful of is, number one, what's the range and how much does this stock actually have the ability to move? So you can see here on the daily chart, sometimes you move $6, you have $4, $6, even here there's $3. So like scaling out for 60 cents is really kind of like that's a little bit too scalpy, right? And there are times you do scalp trades and there are times you do day trades. So when you have like a multi-hour pattern, then that's not really a scalp trade, because you have a multi-hour pattern. The longer the pattern, the longer your hold times are. The second part is, we have our 9 EMA curling up here. And so, in general, I can at least follow this 9 EMA. And once it starts to get a little bit extended, I always think like if I can fit my thumb between where the stock is and the 9 EMAs, now it's probably getting a little bit, spacey. That's usually a good spot to sell some. And so I think that was really my mistake on this thing was, I just got a little bit excited and I scaled out of those first halves too quickly. My other sells like at, the 72.25, like that should have been probably where my first sells would have been, because that would have been like $1.25 gain. I risked 50 cents. I think that's appropriate. But the other aspect of things, and this is something you guys got to be mindful of, is, as you're watching a stock, if it starts to trend, so I use a 9 and 20 EMA, you can see like this thing, like as it dips, it's holding and then ripping back, right? And then it's just dipping and holding and ripping back. And so, you've got multiple, just like a nice, and later in the day, like you'll come back and test the 20 EMA more than the 9. So especially with the stock with this type of range. So, it's respecting its moving average. I could have held up like, let's say the last 100 or 200 shares and, had myself a much better day than just kind of selling out of all my shares. I think the last of my shares sold at 72.33. So I took like $1.33 versus taking potentially $3, right? And you're never going to take the whole gain on your whole position. But what you want to do is, right, even if you have an extra, if your last 100 shares or your last 50 shares, you're able to ride up and just keep raising your stop sum of, below your EMAs. You could take what's like a few $100 trade and make it into $1,000 trade, right? If you do it properly. So hopefully that helps. If you like these videos, give me a thumbs up. And always, we're making new videos. So you subscribe to our channel. Feel free to leave me any questions, comments. Guys, I love chatting with people. If you ever want to email me, my email is kunal@bullson.ws. I look forward to hearing from you. It's 8:50, so I got to get into class. As you guys probably know, this is the time that, we hop in our chat room and I go over, the game plan with my students during the day. And so I'm a few minutes late. Guys, we have been having a ton of fun in our chat room, and we got a good group of people in there. You guys are more than welcome to join us. We got some really good traders in there. Guys, have a good day. Look forward to seeing you. Peace.